You can find a lot of free resources on the internet to get a better understanding of options, but I thought I'd include a lecture on options basics anyway, just because I find a lot of the online resources to be overly confusing or use poor analogies. Also, there's no need to spend a lot of time trying to understand any advanced option strategies for the purpose of this trade. So let's go over what you need to know about options. I think the best analogy for understanding options is to think of them as insurance policies. Everyone knows how car insurance works. You pay $100 a month for protection, and if you get in an accident, your policy pays off. If not, it expires worthless and you need to buy another month of it. Options are insurance policies for stocks. Let's suppose you own 100 shares of the SPY, the Spider S&P 500 ETF. And let's say you want to buy insurance against a market crash. This is easy to do in the options market. All you have to do is pick the price where you want your insurance to pay off and figure out how long you need insurance for. Let's say you want to buy insurance against the possibility that the SPY will drop below the 215 level, and you want insurance for the next 2 months. All you have to do is bring up your handy options chain, which is available from any electronic broker or even on Yahoo Finance. We want insurance against a down move. That means we want puts. Insurance against an up move is on the other side, the call options. Then find your month. In this case, we'll pick March 17th of 2017. Then your price, $215. And right now, we can buy these for $2 per contract. The next thing you need to know is that each option contract always covers 100 shares, which is handy since we already own exactly 100 shares of the SPY. So one contract is all we need to buy to have insurance for our entire position. We're going to pay $2 for the contract, which will cost us $200. Our position is worth 100 shares times about $225 per share, or roughly $22,500. So this insurance would cost us about 1% of our position to insure it for 2 months. Now you can see if you bought this insurance every 2 months to protect it for the entire year, that would cost you about 6%, which would eat into your yearly profits pretty bad. This is a common dilemma fund managers face: when to buy protection and how much to buy. This is also called hedging. Let's look at the 215 level again. Here's the value of our option at $2. The blue part of it represents the premium. This is the amount that will decay over time until expiration, when it goes to 0. If the price of the SPY stays where it is for the next 2 months, our option will gradually lose value until it disappears on the expiration date. Now suppose the price drops down to 208. In this scenario, our insurance starts to pay off. You can see that the intrinsic value of our option is now $7, and we still have $1 of premium left, making our option worth about $8, or about $800 total. No matter how low the SPY drops, we can't lose any more money than if it was at $215, because our option will gain in value the same amount that our shares lose value, canceling each other out. The value of our premium will expand and contract as fear goes up and down, and it will also decay with time. 2 more useful metrics we can see in our broker's options analytics screen, which is going to look a little different from broker to broker, but all of them give you the same information. First of all, we can see delta. This tells us how much the option will change versus the stock. So if the SPY drops by $1, our option will gain 23 cents. It also gives us a rough estimate of the odds that this contract will expire in the money, or in other words, not 0. 0.23 gives us about a 23% chance. Data gives us the expected time decay per day. This option will lose about 3 cents of value every day until expiration. And this includes weekends, not just trading days. The rate of time decay is fairly steady until the last 3 weeks, where it decays much more rapidly. That's about all you need to know about options to use them successfully. They're basically a form of insurance, but obviously, you don't need to own the stock in order to buy or trade them. You can trade these insurance policies by themselves, but that's a lot riskier than trading stocks, since about 90% of options end up expiring worthless. It's generally a good idea to make sure you really know what you're doing before trading options. And remember to start off small, or even with a practice account if you're a beginner, so you have some experience under your belt before making larger trades.